So something that I've been noticing lately is that a lot of these business opportunities that I've been posting, a lot of the sellers are open to seller, financing.
Danger.
I don't think a lot of y'all actually understand what that means. Let me break it down. When you hear seller financing,
Run.
all it is the seller acting like the bank. So instead of you going to a traditional bank like Chase, Bank of America, Wells Fargo, the seller would just say, hey, I'm going to finance part of this deal myself. So lately I've been seeing more of it, and I'm going to tell you why. Because the economy is changing. Interest rates are going up, banks are tightening up. Obviously, when banks are tightening up, then they don't approve as many people. Like, they don't give out that many approvals. The pool of buyers gets smaller. When the buyer pool gets smaller, that means that sellers have to get creative on how they want to sell their property.
And that creativity, ladies and gentlemen, is where a lot of you guys get in trouble. Hey guys, Robert here. Welcome back to the channel. Today, I want to go over some of the things that you should watch out for if you're someone that is entertaining a seller finance real estate deal. And the reason I want to make this video is she's right. In times like these, a lot of you out there that might not meet income requirements or credit requirements but want to purchase real estate can fall susceptible to these very one-sided financing schemes if you don't know what's going on. So stick around to the end. I'm going to give you 2-3 tips that you should look out for. And at the end of the video, I'm going to show you that a lot of you guys that think you can't go traditionally or do a traditional financing where you're going to have better terms and less predatory activity, in my opinion, you'll be surprised that you can qualify. Why am I able to talk about this? 20 plus years as a residential loan officer. And on this channel, we simplify the home loan process. Leg up.
Honestly, that's just supply and demand. So if only a handful of people can qualify for traditional loans, then that means that 9 times out of 10, the property that's trying to be sold by the seller is just going to sit longer.
Now, she makes a valid point. Traditional loans, there are certain criteria one has to meet. But what a lot of you guys out there don't realize is today there are several non-qualified loan options, non-QM loan options that are available that address a lot of the challenges, the barriers that would prevent a lot of you from going with a traditional lender. One is called asset allocation. An example of that type of loan is, say you're somebody out there that has a lot of assets. You have a pool of money somewhere that you derive from a legal source. There's ways that you can take that money and convert it into income. No verification of employment requirements, no income documentation, none of those things. So asset allocation loans are huge, especially for business owners, because you may be someone that is relatively new in business and have accumulated these funds, but have not had the business for the time frame that you need to have it.
Guess what? Every month the business is there. It's costing the owner money. Taxes, insurance, maintenance. They're still paying rent. They're still paying on the utilities. The insurance, like I said, they're still the landlord. They're still the person who still has to make those payments. Especially if there's, employees, then they still have to, pay those employees. So money is still going out whether they're making a sale or not. So again, instead of the, seller saying, okay, I'm gonna wait on the banks, they just get creative themselves. They will find a way to finance part of the deal themselves.
And the way they do that is they attract those of you out there that really have credit issues. When these sellers are going through all these things that she's mentioning that are accurate, these things should actually be benefiting you as a buyer, because if the seller is hurting in these areas, the mortgage is still there, the utilities, all these things that they're having to pay, they may be over leveraged. Well, that should be an opportunity for you potentially to get a better deal. But again, most people don't understand that there are options available that don't have to go through the traditional methods. 2 years tax returns, the verification of the employment, your CPA letter, or a profit and loss statement. All of those documents that you might not have, those products that I aforementioned will handle those things. For some people, seller finance deals are the way to go. But the people that win, okay, the people that win from these deals are winning because the seller is in distress. Well, these sellers then take that distress and they find where you're distressed because of your credit and a lot of issues or a lot of circumstances, pardon me, or the fact that you can't verify your income, and they take their situation, right, and take advantage of you because you'll see that these deals aren't cheap and you have to have what they call skin in the game.
Instead of having maybe 10 people that qualify, now they may have 50. And that is why seller financing can actually increase demand. Opens the door for more qualified buyers to make an offer. Let me clear something up because I know how the internet works. Seller financing does not mean you can come in with $500 down. It don't mean you can come with $1,000 down. It doesn't mean no money down. It doesn't mean your financial situation doesn't matter. Most sellers want at least a substantial amount down because they want to know that you have skin in the game. Because they're taking a risk too. So if they finance the deal and you stop paying, now they have a problem.
So for those of you that hear these types of things, generally they're people dealing with bad credit or challenged credit, and you have very little money. These are breeding grounds for you to be taken advantage of. Editor put this video here that I did about a young lady in the St. Louis area that fell susceptible to a Facebook ad that was basically saying you could get this house for $2, okay, only to find out that it's a scheme. These are things that you guys have to watch because even in the seller finance realm, they're not doing anything for free. You can't have $500. You're going to put down 10, 15, 20%. If you have those types of funds, I'll reiterate, asset allocation or bank statement loans get you around the hurdle of traditionally validating those income sources. And the interest rate when you do this traditionally is going to be much better than when the seller finances you.
They want to qualify you. They're still going to ask you questions. Still going to make sure you can actually afford. Now here's why I like seller financing, because sometimes it's not about you getting the cheapest deal. So, realistically, when it comes to the state, it's always about the best terms, the best structure of the deal. And in this situation, this works out when it comes down to the best terms. Would you rather pay a little bit more for flexibility or be 100% denied by the bank where you absolutely have no opportunity? A lot of wealthy investors understand this. They don't just negotiate price, they negotiate the best terms.
She mentioned commercial real estate. We finance commercial real estate as well. Same situation, just a little different structure. But when it comes to the financing, the same thing. From a seller to a buyer, if a seller is in distress and needs to move something, and buyers don't have the ability to validate their income traditionally, well, how do they successfully come together and make a deal? Non-qualified loans. Same concept, asset allocation, bank statement type loans. There's asset depletion type loans, several concepts that are really taken from the commercial realm and applied in the residential realm. Same concept residentially with a lot of you folks that get taken advantage of and actually lose a lot of money because the terms are written in such a way where either you're going to pay an exorbitant amount of interest as well as a large upfront amount, aka skin in the game, down payment, to make sure that the seller is comfortable. Because remember, the seller not only has to cover his nut, his debt service, but they're not doing it for free. They're going to make a profit. So you have to understand, if you go along this route, there's a reason wealthy people do it. And so you got to hear that. Are you wealthy? Okay. And you best believe if a wealthy person comes in and finds a seller in distress, the terms are going to be in their favor. You got to make sure the terms are in your favor if you're going to do that. And all the deals that I've seen, all of them, if you're not wealthy in your mind as far as how to do these things, as well as have the actual dollars to structure these deals, they're always benefiting the seller and not you, the buyer. And most of you guys end up losing your money.
Because good terms can create opportunity that cash alone can't. The next time you see me post a business opportunity that says seller financing available, don't just scroll past it. Understand what you're looking at. You're looking at a seller who's willing to work with the right buyer. And in this market right now, that's very valuable. Because in this business, the money doesn't always go to the person with the most cash. A lot of the times it goes to the person who knows how to structure the deal.
I agree 1,000%. Shout out to her. She's doing her job as a realtor. She's out here marketing and trying to show you all, those of you that she's talking to, that there's options out here to purchase real estate. But I'm focusing on you all that are looking to finance, to let you know that there are non-qualified, non-traditional ways to use your income that you have to get into these deals. To reiterate, asset allocation, asset depletion, bank statement loans, just 3 ways that are non-traditional ways to qualify your income. Most of you all that gravitate to these types of deals may hear, I could get a house and I don't have to have any money. Well, she just told you, and I'm co-signing what she's saying, you can't get into these seller deals without any money. Why? Because the seller has to get enough money from you to make sure that they're comfortable. Same thing a bank is going to do, right? Secondly, the interest rate. Nobody ever talks about the interest rate, but a lot of you guys are very interest rate sensitive. When you do these types of deals, the interest rates are going to be higher. Traditionally, with these non-qualified loans, you start in the 7s and up. I'll say to 7 to 10%, somewhere in there, depending on the loan to value and your credit score. When you deal with these seller finance deals, you're looking at 15% and higher. And a lot of you guys don't understand how it works because they hit you with the payment. Well, you could go to any mortgage calculator online now, and this is how you find out what the interest rate is. Residential or commercial, when you run into these seller finance deals. How long are they financing it? The term, right? We use months when you're doing an amortization schedule. 30 years is 360 months. 20 years, okay, 240, 15 years, 180, 10 years, 120. You just take 12, multiply times the number of years, that's the months. That's the term. You need the payment, and you back out the taxes and insurance. You just want what the payment is. And most of these people are just telling you what the payment is. They're not factoring in for you the escrow. So the payment, so you got the term, the payment, and then the purchase price. What's the loan amount? I said the purchase price. So if you got 3 variables, you could find out, you could solve for the 4th one, which is interest rate. So if you got the loan amount, you have the term and the payment, you could solve for the interest. And if you put that in a calculator, it will show you, and a lot of you guys will be surprised. There you have it, ladies and gentlemen. This is how you protect yourself in these times, because these times bring out a lot of creativity. And if you're not careful, that creativity can end up costing you greatly. If you're out there and you say, I did not know that they have all of these other types of financing, I'd like to have a conversation with you. Go down in the description of the video, click the consultation link, and let's have a conversation. Let me hear what it is that you're trying to achieve, because you would be surprised at the amount of non-qualified mortgages that are out here for folks just like you or fit these situations. For the rest of you, I want you to continue watching these 2 videos so you can educate yourself on how to properly get into your next home, or in this case, commercial deal. You guys be good to one another. Let grace abound. But most importantly, y'all stay blessed. Indeed.